Hello and happy New Year's, guys. Hope we're all doing great. Welcome to the first official video presentation from myself, Ari Van Gemeren, and Lombard Equities Group. Excited to share some thoughts on our 2024 year-end newsletter, as well as a few thoughts on 2025. First of all, if you're watching this, thank you. Hope you have a great New Year's Eve. Enjoy your day. Enjoy a festive and fun night, as it should be. For me, I'll be in bed around 8 p.m. as I have 4 kids, including a 6-week-old, and we are barely surviving over here. So I'm excited that I'm even doing this video. This is awesome. It's our first time doing it, and happy to share some thoughts with you guys. So for starters, let's talk about 2024. 2024 was a heck of a year to be a real estate investor, good and bad. And I just want to highlight one comment before we even start this thing. This is a story of two different group. If you already own buildings, you've already been putting capital to work, your own or investors, it is one story. If you are buying, if you're starting your business today as a syndicator, or you're looking to buy stuff, it's a totally different story. I think the opportunity set as a buyer right now is fantastic. The situation, if you're a current owner, is a little more nuanced. Let's just call it that. So what happened in 2024? There was a lot of chatter going into 2024 that it was going to be the year. Things were going to be great. Rates were going to come down. Cap rates were going to come down. Buyers were going to flood back into the market. Multifamily was going to be saved. It was going to be awesome. Didn't really happen that way. Wasn't a disaster. Wasn't great. It was kind of a middle of the road sort of deal. So I would argue that even if the bull case scenario had happened, right? Inflation came down dramatically. The Fed starts cutting dramatically. Long rates start coming down. I don't think buyers were going to flood back into the market. There's a lot of reasons why. I can go into many reasons why I think it's the case. I just think most buyers, especially in the group one that owns assets right now, is very mindful that the deals that are being done need to be like incredibly fundamentally sound. And it's not the level of interest rates, although it doesn't help, but it's not the level of interest rates. It's the volatility of interest rates. So let's get into that first. So let me pull something interesting that I put together for this, which is, by the way, also in the presentation that I'm sharing with you guys. So let's just look at this real quick. This is the 10-year Treasury yield over the course of 2024. Now I ask you, how does one get a deal done in this environment? I mean, this is some significant volatility in an asset class that's typically known for stability, right? Here at the beginning of 2024, it was exciting. It was under 4%. Inflation was coming down. Things were looking great. And then by May, we were like almost at 5%. And then by October, we were back at almost like 3.6%. And then here we are today, we're back here above 4.5%. This is really volatile. And I want you to consider something. If you went in contract like here, you typically don't lock your interest rate here. You get in the contract, you get through due diligence. Okay, now the lender's got to go through some stuff. You might not be locking till here. So you underwrote a deal here and you lock here, right? Or conversely, which actually this happened to us, you go into contract here and you close here. Now you look like a rock star, right? But or here you look like not a good situation, right? The same situation's playing out for the lenders. The lenders are trying to figure out how to price their debt when they have to give you a loan. They're trying to figure out how to price the debt in a way that they don't get their face ripped off by offering you terms here, and then like their funding cost ends up being up here. It's a very difficult situation, and lenders are dealing with the volatility by increasing their spread. So it's not like everybody's a 150 spread and you can just game the market in terms of where you think rates are going. Lenders are also just increasing the spread to control for volatility. So that is a significant issue, right? Volatility is a significant issue, and there is what we would call in Wall Street parlance a volatility premium being placed on assets right now, which is great if you're a buyer, really tough if you're a seller. The second major story from 2024 that I want to highlight is the growth in operating expenses for buildings. So this is this is bad. Like, there's really no other way to say it. Like, operating expenses, by and large, have grown by 7.1%, right? Sometimes much more. And a lot of these things are increasing probably even more than what you're seeing here. The insurance cost is the biggest and hairiest driver of rising costs for buildings. NOI supposedly increased by 4.2%, but I don't think that's actually the case in many markets that people are operating in. So, like, you've lost value this year just on this trade. Like, your NOI has dropped because of the rise in operating. It's a tough situation. That's why I say if you're an existing owner of buildings, it's tough. Like, we are navigating this. Many of you are navigating this. Like, this is a situation we're trying to navigate. It is a really great opportunity if you're a buyer. Real quickly on a regional discussion. So my firm, Lombard, invests across the West Coast. We invest in Northern California, Oregon, and Washington. So real quickly, quick hit list of the three. Worst performer, Northern California. Really tough market. The San Francisco Bay Area is struggling. The situation's not great. Like, there's the employment situation's not great. San Francisco is, in my opinion, is sort of driving it. Like, rents are down in San Francisco. It's a really attractive place to live, or has been historically. And so it's having a suction effect on other markets, especially in the periphery of San Francisco. I think if you get further out into the suburbs, it's probably okay. Walnut Creek, the Peninsula, San Jose, they're probably doing okay. But like Oakland, specifically Oakland, the big one, is not doing well. And I think it's driven by San Francisco. The local politics has been really difficult to deal with because they will change the rules on a whim. And it's very difficult as a long-term investor to make a business plan in a city where they'll just change the rules, and they'll change it in a material way, which is really difficult, which is a risk of investing in places with high levels of anti-landlord sentiment. So it is what it is. The second, I guess the middle performer, in my opinion, is Seattle. So Seattle is a great market, a great city, very deep business ecosystem, a lot to like, and a supply-constrained city. Leasing has been difficult because there was a lot of supply that was recently delivered. But we are moving past that, and I think Seattle is starting to look really good. Amazon, Microsoft, major employers in the market have been very aggressive on hey, you got to come back to the office or you're gone, right? And that is playing into our thesis of the renewal of the urban core on these major cities. So Seattle is coming into its own. I think the future looks very bright. The best performer, surprisingly, is Portland. And I wouldn't have guessed that going into the year. I probably would have said Seattle was probably top. Portland, vacancy is good. Leasing is good. Rents are up. We're finding great deals. I will attribute that to a couple things. I think the situation on the ground in Portland is changing markedly. We recently elected a very moderate district attorney that is actually enforcing the law. The situation on the ground is looking good. There's a lot of green shoots rising. Portland is also ahead of the curve on the housing supply issues. In a bad way if you live here, right? Because costs are going to go up. In a good way if you're an asset owner. The reason is that Portland's overdevelopment happened. The oversupply has already been delivered, and we're kind of past that point, and there is nothing being built here on out. And Portland has the added benefit of not only is it a supply-constrained city, it's a beautiful city, 1 hour access to Mount Hood, great skiing, right on the rivers, 1 hour access to the beach, and it is the cheapest West Coast city from a cost of living standard for now. And so we continue to have people moving here. People continue to like it. It has a decent business infrastructure. I would say Seattle and the Bay Area are probably stronger, but Portland has a lot of benefits to it. Nationally, can't opine as much because we don't invest there, but we've seen some big failures of deals, specifically in the red state exodus locations like Texas and Arizona. There's a lot of reasons why. I go into it a bit more in the report, so you can read about it. Let's talk about what my firm did in 2024 real quickly. So we continue to acquire. We acquired 3 buildings, about 150 units worth of assets, and all vintage. So we've been playing in a space that there's just not a lot of competition. So 1910 to 1930 style buildings in the core of these major cities, Portland and Seattle in particular. And we're just seeing great pricing. Like there are known challenges with those buildings, but what I also know is nobody wants to buy them. So we are able to get really interesting and good pricing for those buildings. We've also been focusing on operations and performance. So like everybody in this business, how do we drive better operating margins? And a lot of that is better systems, better integration with our property management companies, better management of the management companies. These are really important things that everybody in this industry is working on right now because it is the one thing we can really control. So that has been the focus for 2024. For 2025, I think there's some really big opportunities. The biggest, I already highlighted it, I think there is a huge opportunity in vintage buildings. There's nobody playing in the space. Everybody knows the problems. Insurance is a problem. Earthquake risk is a big problem. It is what it is. Systems issues are a problem. So you can rectify a lot of these with really good and strong due diligence going in. But at the end of the day, you can buy a primo, beautifully located, fantastic asset for really cheap right now. And that's what we've done. That's what we did this year. And every single one of our deals we bought this year had a much higher cap rate than the actual financing cost. So very positive leverage going in, really high cash flow out the gate for investors. In my opinion, relatively low risk, especially financial risk, because the buildings have been acquired at such a great basis. So to that end, we are raising a fund starting this year, a $20 to $25 million fund with a specific focus on acquiring vintage assets in our main target markets. So the markets we're going to look at for this fund, Seattle, Tacoma, Portland, Vancouver potentially, but the vintage building opportunity is in those markets, and we're going to be going after that thesis strong. We think it's going to be a very high cash flowing fund with good opportunity for equity appreciation because they should not trade for 7, 8, or 9 caps, historically speaking. There's a very wide spread between those buildings and everything else, and we know how to run them and operate them. We have a huge portfolio of vintage buildings. It's what we're going to go after. We are also in 2025 really excited to share that we're going to launch a podcast. So we're going to be talking with some amazing real estate investors across the country, how they built their businesses, what they did getting into this, what are they seeing, what's out there, what's happening. And we're going to apply a historic lens to our analysis of this. I'm a history guy. I studied history in university. It's a passion of mine. So we're going to be, how does this play into historic themes, different things that are happening in the market? How can we learn from history what people have done to build our own businesses and to grow in this business and to serve our investors better, to build better portfolios and to leverage the lessons of history to not make the same mistakes. We'll also be publishing a few books next year, so stay tuned for those. The first one will drop in January 2025. I'm really excited about this. I like to write, and I'm excited about some of the stuff we're coming out with, so stay tuned for that. If you are interested in the fund, please reach out to me directly. You can DM me, email me, comment, whatever you want to do. Let's get in touch. Let's talk about the opportunity. If you are a rising sponsor, so somebody that wants to get into this, you bought a duplex, you bought a quadplex, you want to learn how to syndicate, create your own deals, build your own company, and you're here in the Pacific Northwest or you're anywhere else, let's talk. There's a lot of ways to work together. We're interested in looking at new markets and we might be able to partner with you on those. And we want to teach you how we built what we did and let's get together and discuss it further. So please reach out. I look forward to talking to you. And again, have a very happy New Year's. Enjoy yourselves. Have a great time. I know I won't. I'll be sleeping, but I am sure you guys will have a good one. Thanks. And we'll see you all soon. Bye now.